Hello Year 11 and welcome to our sixth video here for our sixth topic. We're looking at income tax and the Medicare Levy here, and we'll need to move quickly because this is fairly complex and a fairly common question to be asked. Now, we have a federal government. There'll be an election soon, what do you know? And they spend money on things like health and education, defence, welfare, all this sort of stuff. Right? That costs lots of money. They've got to get that money from somewhere, and one of the places they get that money is from this thing called income tax. Right? When you earn money, then you may have to pay income tax on what you have earned. Right? A portion of what you've earned might be paid as income tax. Now, not all of your income, perhaps, is subject to income tax. Right? Money that you have spent on work-related expenses, right, like maybe tools or a uniform or something like that, perhaps, or donations to charities, right, that part of your income, of your gross income, is not subject to income tax. So, the only part that is subject is your gross pay less those allowable deductions, right, and what's left is called taxable income, right. So, your gross pay minus allowable deductions is your taxable income, and that's what's used to calculate your income tax liability. There's an example there of some allowable deductions, right? That varies from job to job. Depends on what you are doing, right? Depends on all sorts of things, I suppose, and changes over time sometimes too. Anyway, income tax calculated on our taxable income, which is rounded down to the nearest dollar. It's done over a financial year. That's from the 1st of July to the 30th of June the following year. And it's what we call a progressive tax, that as you earn more, you pay a higher proportion of your income in tax. So, currently, I think these rates are probably still current. If you earn up to $18,200, you pay no tax, right? Anyone earning less than $18,201 per year doesn't have to pay their taxable income, doesn't have to pay any income tax, right? That's called the tax-free threshold, 18,200, right? That's the threshold, some sort of limit, up to which you don't have to pay income tax. Now you'll see that if I earn up, so above that amount, but less than 37,000, I pay 19 cents in the dollar for everything sort of over the tax-free threshold, 19 cents, and gradually it goes up to 45 cents in the dollar for any dollar over $180,000 that you earn. The sort of part of your taxable income that is below each of these thresholds is taxed at the lower rate. So no one pays a total amount of 45 cents. No one pays sort of 45% income tax. Right. If they earned a very, very large amount, right, in the millions, then they might approach this as these amounts less than $180,000 become a fairly insignificant part of their income. But generally speaking, in fact, I could say here that more than half of all people filing a tax return would pay less than 32.5 cents in the dollar for their sort of last dollar earned, right? The highest rate of income tax that you pay, because you sort of pay it at your top rate and everything below that, the highest rate is what we call your marginal rate of tax. Now, let's have a look. We'll use this table here, and that will be provided to you in any question that you need to answer. Let's have a look at an example. Cindy earned $56,375 and claimed $326.20 in work-related expenses, $125 in donations to charity. First thing we need to do for Cindy is to work out her taxable income, right? So I'm going to say taxable income, TI for taxable income, is $56,375 minus the $326.20. And we also need to subtract the 125, okay, because they are allowable deductions. Now, thank you, calculator. Here we go. Clear that away. And 56,375 minus 326.20 and minus the 125 equals 55,923.80. In fact, I'm just going to leave it at 55,923 because it's only your taxable income, really, is only the full dollars, right? You round it down. That's my taxable income. Now we need to work out how much income tax. So we take this amount, 55,923, and we have a look at the table and see which of these brackets we fall into. Cindy does not fall into the 0 to 18.2 bracket. She does not fall into this bracket. Cindy is in this bracket here. So that tells me that this is the formula for calculating Cindy's income tax. So the rule here is that Cindy needs to pay $3,572. I'm going to say tax. Let's say tax equals, right? The rule is 3,572 plus 32.5 cents. Right, I'm going to say that's 0.325. That's 32.5 cents times everything over 37,000. I'm going to put a little bracket here. I'm going to say that's 55,923 minus 37,000. Rightio? So that's how the rule works. Cindy is going to pay $3,572 plus 32.5 cents for each of these dollars that is above 37,000. Right? I'm going to do this sort of in parts here. I'm going to say this is still 3,572 plus 0.325 times, come on calculator, so we've got the 55,923 and we subtract the 37,000, right, and that tells me that Cindy has earned $18,923 above that 37,000 threshold. So we've got 18,923, right. Rightio. We're getting a bit closer here. You should always show some working. You might not have to show this much, but I just want to do this to explain how it goes. Now I take that amount and multiply it by the 32.5 cents times 0.325, right? So that's the amount in dollars. So 6,149, let's say 98, 6149. Rightio. And now I'll add those two numbers together. Plus, 3,572. And we get 9,721, say 98, 9,721. Right, that's how much income tax Cindy should pay on her income, on her taxable income. Now, Medicare Levy. What's the difference between a tax and levy? Well, a levy is for a specific purpose, by and large. So the Medicare Levy is essentially another tax that you pay. It's very similar to income tax, but it's supposed to be used just to support Medicare, our public health system. It doesn't pay for all of the costs of Medicare. It just adds to other money that's been put aside for Medicare. Now, there are some exceptions to this. There's some complications to it, but all we need to work with at the time being is that the Medicare Levy, 2% of taxable income. Right, so you work out taxable income, and you can work out the income tax from that, and then you also find 2% of the taxable income, and that also needs to be paid as the Medicare Levy. So you need to pay your income tax, right? Cindy would pay this much, plus another 2% of this, right? So, calculate the Medicare Levy for Suyen. This is Suyen's taxable income That's already got the allowable deductions removed from it, so all I need to do here is go 0.02, that's 2%, of 62,379. Righto, calculator, do your magic. So 0.02 times 62,379 equals 1,247.58. 1247.58. Right. Suyen needs to pay that much Medicare levy. Suyen also needs to pay income tax, which we calculate using that table above. Right, you pay both of those things. They're essentially two different taxes, but they're sort of paid at the same time. Righto. That's income tax. We'll look at it a little more in the next exercise as well. Income tax and the Medicare levy. Just remember that it's calculated on your taxable income, not on your gross income. And you calculate your taxable income by subtracting your allowable deductions. Not the same as your net pay. Right? That's a different thing. Your taxable income is your gross pay minus allowable deductions, which are things like work-related expenses and donations to charity. Rightio. Enough of that. If you've got any questions, jot them down, and I will, of course, see you in class.